Welcome, everyone, to Tax to the Max for this week. It was a really interesting week. A lot of different stuff. I ran through this yesterday, sort of a dry run. Takes about 22 minutes for my explanation of these items. So if you have 22 minutes, stay with us. This is our disclaimer. You are welcome to Tax to the Max. I acknowledge the value of my subscription to Tax Notes today, published by Tax Analysts, which is, in my opinion, the preeminent source of tax information coming out of Washington, D.C. Tax Analysts is the advocate for practitioners like you and me. They are not part of any international corporation like a couple of the other tax services. They're totally independent. And Tax Analysts has not hesitated to bring litigation at the federal level to make sure that we are getting information that we are entitled to out of the Internal Revenue Service. That's me. I decided it might be helpful if we got acquainted, if you knew why I was here. I'm here because I've been at this for a long time, and at least the Ohio Society of CPAs thought I was helpful enough to give me their gold medal. But that was in 1995. Turns out, when I think about it, that was a long time ago. So maybe you would give me a gold medal, maybe not. If you have questions, please send them to this email address, lynnnicholscpa@outlook.com, or send them to the Cpa chat room. I'll pick them up from either place, and we'll get them answered within 24 hours. Or you can ask questions today. The wonderful thing about this setup is you can unmute yourself, or you can request to be unmuted and ask your question, and we'll answer your question. And if I don't have the answer, maybe someone else who's on the call will have the answer. I have 7 items this week. We're going to talk a little bit about modeling to get the answer to a difficult tax question. And then the IRS has explained there is no exemption for an organization that wants to serve marijuana during its worship service. An S corporation makes distributions to pay taxes. That's not a partial liquidation because they have a shareholders agreement. I'll talk about the importance of a shareholders agreement. And then termination was inadvertent when a trust became an S shareholder. It was a result of poor planning and poor communication, and the IRS gave the S corporation what a golfer would call a mulligan. You may recall that over the past few weeks, I've talked about the new fast track process to get a letter ruling on corporate matters. A merger, a disposition, a spin-off, split up, those have some fairly delicate tax requirements. You may want a private letter ruling instead of your own tax opinion if a lot of dollars are involved. But typically that's taken months. Something is amiss with my slides. They have somehow picked up a 45-second change. I'm going to take this one back a notch because I wasn't quite ready to change. Maybe we'll change, maybe we'll not. I thought I went through the slides and picked all those up. And then we're going to talk about common tax mistakes when you're mediating a lawsuit or involved in mediation. CPAs should be involved in mediation because the tax provisions frequently are an important consideration. And then finally, for everyone, the 2022 limits on the depreciation of automobiles. All right, here we go. What if? Worst case? What percentage? How do you answer that question without modeling? What if? Well, let's change the facts a little bit and then press the buttons and see what the software does with these facts. And then let's change the facts again and see what happens with those facts. That's called modeling. And the way to deal with one particular difficult tax issue coming up is to model the liability of a partner who has a bottom dollar guarantee. There are 3 ways to determine whether a bottom dollar guarantee really is a liability which allows the partner to claim the liability as providing basis. You can use the three-tier process described in the regulation for allocating non-recourse debt back to the partner to ensure that there is enough debt to cover the projected losses. You might also use a technique called vertical slices, in which a partner's payment obligation is stated as a fixed percentage of every dollar of debt to determine, is there enough debt attributable to this partner? And in a partnership, a partner gets basis for the partner's share of partnership debt. Is there enough debt attributable to this partner so the partner has debt to cover losses that are projected from the partnership operation? You're sitting there thinking, you know what? I've never seen a projection like this, except in the case of tax shelters. Aha, there you are. That's why the IRS is interested in it. That's why partners have been particularly careful about bottom dollar guarantee. That's where the bottom dollar guarantee came from in the first place, is in tax shelters. So finally, you could place a cap on a partner's risk of loss under that partner's payment obligation. And if you increase the cap, then you have increased the partner's basis and the ability of the partner to claim losses. The point I want to make here is there are no shortcuts if you want a good answer. The problem needs to be solved by October, and we've had 7 years to get it done. But here we are. Some of us are dead up against it, and you're going to have to make sure that you have enough debt basis to allow your partner to claim the losses they expect to claim. Marijuana, hallelujah. Nope. Where's the wafer? Am I being disrespectful? No, I hope you don't think so. We try to get a laugh here every now and then. Here, the IRS denies the church's application for tax exempt status because the substantial activity of the church, they're not real sure how much or how long, is consuming cannabis during worship services, which is itself an illegal activity, but it serves a substantial non-exempt purpose. The congregation is simply getting stoned. They claim a minister consecrates the dried fruit, and by the grace of our Creator will become the, I presume they mean the sacrament, which Roman Catholics have believed for centuries. The sacrament, the bread and the wine, represents the body and the blood of Jesus Christ. I don't know whether this is sacrilegious to even suggest it or not, or even to talk about it. I hope you don't think so. But someone actually had the, whatever it is, to ask for a private letter ruling so their church could consume cannabis, and contributions to the church would be tax deductible. Shareholders in an S corporation should have an agreement. What should that agreement contain? Qualifying and remaining an S corporation requires compliance with a number of rules limiting ownership and classifying distribution and retention of income. That's what you need to cover. In this ruling, the IRS ruled that distributions an S corporation made to its shareholders under an agreement so they could pay federal, state, and local income taxes on their allocable share of S corporation income are not considered distributions. The thing about this is the shareholders would have different tax liabilities based on differences in their taxable income. They can claim a distribution and demand a distribution to pay the taxes on their allocated share of S corporation income, even though that might be at a different percentage than some other shareholders. So you're going to have disproportionate distributions. Under an S corporation, shareholders agreement will not terminate the S election. It's an important thing to know. What goes into the S corporation shareholders agreement? You want to limit the transfer of shares. You want to require the approval of all wills and trusts that would dispose of S corporation shares. You want to agree on distributions to pay taxes and distributions to comply with any court order. You want to agree to withhold distributions in response to a court order or to honor an IRS levy. And may be accounted for as loans. If you do that, the IRS cannot attack your disproportionate distributions. An S election mulligan is possible. I spoke about the Mulligan in the introduction. Here, the S election and any rules allowing a trust to be a shareholder are complex. Sign this line, file this form, get the signature of a beneficiary who's not even a shareholder, and send it all in by a deadline. Oh, just thinking about it, I'm exhausted. Mistakes are common, and the IRS routinely grants special rulings allowing most clerical errors to be corrected. But you got to pay a fee. This particular ruling request, corporation wanted to be treated as continuing to be an S corporation owned by a qualified subchapter S trust. The income beneficiary failed to properly sign the Form 2553. But the trust was a qualified subchapter S trust, allowed to be an S corporation shareholder. If all the income is reported by an individual beneficiary, the only thing we had was a foot fault. We can ignore the possibility of income deferral or splitting by the trust if it's properly drafted, and this one was. But the signature of that income beneficiary is required, even though it's self-serving. Well, not this time. If the beneficiary executes a consent letter and all shareholders agree to comply as if the required form was signed, and it is signed and filed now, then the IRS will grant the requested ruling, provided you meet those conditions in that little preceding paragraph. But you got some conditions to meet. That S election would otherwise automatically terminate. When a complex trust becomes a shareholder, and this happens way too often. What about the Mulligan Rule? Well, the failure is a common flaw in wealth transfer planning when a financial planner, not familiar with the rules on limited S corporation share ownership, takes charge of the plan. And the financial planner tells your client, let's don't bother the CPA. They would be saying no anyway. They're not going to be receptive. They're not. And so the financial planner counsels your client not to talk with you about the financial plan, and the financial planner knows squat about the tax rules that might be violated here. Even though you can take advantage of, you get a mulligan, you got to ask for the ruling and pay the fee. The least amount is $275 plus whatever professional time there is, but that's if the taxpayer's gross income is less than $1 million. If it's more than $1 million, the fee can be more. It can be as much as $15,000. So maybe it's not cheap. Now, about that fast track letter ruling. For the last 3 weeks, I've shared with you the IRS's suggestions, and then they're pleading, please take advantage of the fast track letter ruling. We have staffed a special group to take these corporate letter ruling requests immediately and act on them within 180 days. We can't open the mail. We can't process the returns that are being filed, but we've got this special group over here and they need the work. This is a pilot program. It's fully staffed. It's prepared to act on your request. You got a merger, an acquisition, a distribution, a spinoff, any corporate matter where the client wants the comfort of an IRS ruling rather than your opinion, or maybe tax position insurance. You can now get a fast track letter ruling, and you should. No corporate matter is too simple or too plain. They have manpower over there. They need to be kept busy. Here's the revenue procedure that tells you how that's going to happen. Revenue procedure 2022-1. There's a schedule of user fees. Appendix B is a sample format for the letter ruling request. Follow Appendix B and you can't go wrong. Do what it tells you to do. Appendix C is finally a checklist. Is your letter ruling request complete? If you follow the instructions in Revenue Procedure 2022-1, Appendix B and C, you cannot miss. Mediation. I love this cartoon. We have an agreement in principle. The question is, do we all have the same principles? And I've been involved in mediation where that was the issue. Each side had principles, by golly, and we weren't going to compromise our principles. You know what? You don't have to. We don't want you to compromise for what you believe for a moment. We just want you to change the way you act. Believe what you want to believe. But with respect to this item, we want you to behave a little bit differently. What is mediation? Could you define that, please? Yes. Black's Law Dictionary, mediation is a method of non-binding dispute resolution involving a neutral third party who tries to help the disputing parties reach a mutually agreeable solution. It's not to win or lose. And when I put ELN in parentheses, I'm identifying my thought rather than any other. This is my thought. It's not to win or lose. It's let's just get it over with. And this solution is at least acceptable. I will walk out of here and I will not blow it up. I will behave differently. I will behave in a way that lets this compromise survive. That's a mediation. So I have 3 questions for the CPAs that are on this call. What can a CPA mediate? And exactly what is mediation anyway? We just talked about that. But what can a CPA mediate? A CPA can mediate business disputes. I have partnered with mediators in marital bust-ups where there was a lot of money involved and where children were involved. And my mediating partner mediated the soft issues, the children's custody. I mediated the hard issues, the child support. Who's going to pay for the education? Are we going to pay for private school? When is that going to happen? How's it going to be funded? Alimony support, those kinds of things. I worked on the financial side, but I did not work on the soft issue side. That's not in my wheelhouse. So don't get involved in stuff that you're not trained for. Now, if you have a CPA certificate and a degree in social work, try to mediate everything, but I don't think many of us do. So when should you be the mediator? If all the issues are financial and the only issue is how much is going to be paid, when is it going to be paid, what is it going to be paid in currency, or is it going to be paid in turnips, right? What's the currency? And then finally, you're going to be working with an attorney. The attorney is going to lock up the client relationship for the mediation. The attorney may or may not want to participate in the mediation, but I've had situations where they simply turned me loose as a mediator and monitored the results. The way I relate to the attorney is I honor the attorney's superior relationship to the client. And I expect the attorney to honor my superior knowledge of the federal tax law. That works. We can get along. If the attorney wants to argue about my understanding of the federal tax law, I'm going down the road. That attorney can find another CPA. I'm not the right person for the job. Now, I want to give credit to Robert Wood. Robert Wood is an attorney. He writes frequently for Tax Notes Federal, which is a publication of tax analysts. This was published on February the 28th. It's a wonderful read. It's relatively short. It's only 3 pages, 7 items. Each heads up a 1 or 2 paragraph explanation. Don't bring up taxes too early, unless the whole point of the mediation is taxes. If it's a business mediation that has tax ramifications, don't bring up the taxes too early. Let's work on the business stuff first. And don't fail to consider what the conclusion is going to be. Look through the mediation to what a likely conclusion will be. And we'll talk about what that means here in a minute. Be careful previewing your tax issues. In other words, don't show what you're going to recommend too early. Make sure that both parties have a comfort level with your learning their position and your understanding. Don't fire your ammunition too soon. Wait, at least let them think that you have given full consideration to their unreasonable position. And don't forget statutory exclusions and classifications when you're trying to work out a a compromise. Some compromises will burden one side or the other with a tax obligation they didn't expect. Excuse me. Then beware the binding term sheet. What am I talking about? You're sitting around the table, you've reached agreement, everybody feels good. We're gonna hold hands and sing kumbaya. Wait a second. If you start writing a term sheet, which is just short paragraphs, we've agreed on these things in principle. Remember the cartoon, right? Make sure that everyone has the same principles before anyone signs a binding term sheet, which is going to lock up the results of that mediation. And before it's over, don't fail to consider who's going to fill out the tax forms. Sometimes you burden one side or the other with the tax compliance, or you're going to make a payment to one party. Is it going to be in lieu of wages? Therefore, the party paying the money has to fill out a form W-2, and the party receiving the money expects to get a W-2. I've seen mediations blow up because they didn't understand that. And we're trying to make sure that everybody understands what's going to happen before we get up from the table and leave. Don't fail to include paragraphs that state every party's understanding of the tax provisions in the mediation document, a binding term sheet in which each party acknowledges that they have had a chance to ask questions and they understand how the tax law will affect this settlement. Finally, from super technical to not technical at all, the 2022 depreciation rules for automobiles, first placed in service in 2022. With additional first-year depreciation, the first year is $19,200 depreciation on the automobile, no matter how much it cost. The second tax year is $18,000, the third year $10,800, and every year after that, until you've exhausted the basis, $6,460. Obviously, if you've got a Rolls Royce that costs $250,000 and it's 100% business use, the first year is $19,200, and then it's this schedule. And you get down to each succeeding year, I guess for the next 20 years, you're going to take $6,460 depreciation. That's an oversimplification. Without additional first-year depreciation, the only year that's different is the first year. First tax year is only 11.2. The other tax years are the same, with or without additional first-year depreciation. And that's provided you have 100% business use. Questions about automobile use? Come on, is the prize worth the race? I am so tired of trying to work out automobile use and percentage and mileage, record keeping, the client relationship, Circular 230 rule for the tax preparer's responsibility. I have to believe that the information I'm putting in the return is the truth. The client lies to me, or the client expects me to lie. Come on. Is this automobile depreciation and this automobile business use and even the automobile mileage, is it worth the time and the energy that we expend on it? And should we simply make sure the client understands the rule, and then the client gives you the information, you have some reason to believe the client understands the rule, and so you prepare the return based on the information you got? That should be okay. What do you think about this? I think we're 4 or 5 weeks in now. Every week, this short call is going to feature topics like this. So far, I've not had requests from any Cpa members to cover this, that, or the other in the Thursday call. I would love to have them, and I'm sure, and I will be more than happy to weave those into the program. And then from time to time, we'll have guest experts. I think we've had 3 or so of those already to talk about things that they were expert on. If you got a question, I will do my best to help. It doesn't have to be a question we deal with in this program. I'm committed to the management of Cpa that my relationship with your association is I answer tax questions. Any tax questions, all tax questions that come from Cpa members. It's a benefit of your membership. So even if they require analysis of complex facts, I'm committed to helping if you need it. Until next time, that's my phone number. That's my email address. I'm always happy to help.